So now let's dive into filing statuses, because depending on which category you fall into, your tax benefits and standard deductions can change dramatically. So let's bring back our example taxpayer, Linda Larper. She works at Planet of the Grapes and she's single. A taxpayer is considered single if they are unmarried or legally separated as of December 31st, the last day of the tax year. It doesn't matter if they were married earlier in the year. What matters is how they're legally classified on December 31st. So if Linda was never married or she finalized a divorce before year end, she's single for the entire year. Even if she had a relationship during the year or lived with a partner, none of that matters unless there's a legal marriage recognized by the state. Okay, so one important CPA exam key point to remember is that filing status is always determined on the last day of the year. So if Linda breaks up with Trevor on December 29th and they never were married, she's still filing single. All right, so no messy tax relationship breakup. Next, let's look at married filing jointly, often the most beneficial tax status. Okay, so a couple can file jointly if they are legally married by December 31st, even if the marriage happened at 11:59 p.m. on New Year's Eve. As long as it's a valid marriage under state law, including common law marriage if recognized, then they qualify. Okay, so Linda isn't...
What's going on? My name is Joey and I'm the founder of Universal CPA Review. You're probably here because you're ready to pass the CPA exams once and for all so that you can advance in your career and move on with your life. Let me be the first to tell you that I've been there and I feel your pain. But I'm also here to tell you that the CPA exam doesn't have to feel like such a maze, and there is a path to a passing score. So what are you waiting for? Don't waste any more time. Commit to the process because it will pay off. In my opinion, I say let's knock out the CPA exams once and for all.
In this category right now, but let's pretend she married Trevor earlier in the year. Even if they lived apart most of the year, if they are still legally married at year end, they can choose married filing joint. So here's a tricky situation students often miss. If one spouse dies during the year, the surviving spouse can still file married filing joint for that year. But if the couple is divorced by year end, even if they were married for 364 days, married filing joint is not allowed. So why choose married filing joint? Typically it results in the lowest overall tax bill, thanks to larger deductions and more favorable tax brackets. Next, we have married filing separately. So married filing separately, or MFS, is kind of like the we don't trust each other financially filing status. All right, so each spouse files their own tax return and is responsible only for their own tax liability. It's rarely the best deal because a lot of credits get reduced or are eliminated, and tax brackets are less favorable. So why would someone choose this status? Well, maybe they want to keep their finances separate. Maybe they don't want to be responsible if their spouse cheats on taxes. Or maybe one spouse has high medical expenses and benefits from itemizing separately. So using Linda, if she and Trevor are legally married, but Trevor refuses to file jointly, she must file married filing separately. It's often the more expensive option, but it may be safer one for the taxpayers in risky or complicated situations. All right, so let's take a look at an example. Is this married or single? So let's apply what we just learned. Linda and Trevor decide to separate in December. Trevor even moves out, but no legal divorce or separation paperwork is finalized. On the CPA exam, this is a major hint. If legally married at the end of the year, then they are still considered married for tax purposes. So Linda's options are either married filing jointly or married filing separately. Being separated doesn't change the filing status. Only a legal divorce decree or a qualifying reason to be considered unmarried can do that. All right, so moving on from marriage. Now let's talk about qualifying widow or widower, also referred to as surviving spouse status. This one often offers the same tax benefits as married filing jointly, but only for a limited time. Okay, so a taxpayer can use this status if, one, their spouse died in one of the prior 2 tax years, if they have a dependent child living at home, and if they have not remarried. All right, so thinking through an example. If Trevor unfortunately passes away this year, not predicting anything, but Linda can file married filing joint for this year. So then for the next 2 years, she may file as a qualifying widow as long as she has a dependent child and supports the household. After that period ends, if she remains unmarried, her status may change to head of household. So let's snowball off of that and head right into head of household. Head of household still provides better tax rates and a higher standard deduction than the single status, but you must earn it. To qualify, the taxpayer must be unmarried or considered unmarried on December 31st. They must also pay more than 50% of household costs and have a qualifying dependent living with them for over half the year. So what does this look like for Linda? If she has a child and she's the primary provider, she could qualify as head of household rather than single, which will reduce her tax bill. All right, so a little CPA exam tip. Parents are an exception. They don't have to live with the taxpayer to count for head of household. All right, so more on that next. Who can be a qualifying person? When proving a taxpayer qualifies for head of household, the IRS cares a lot about who the dependent is. A qualifying person includes a dependent child, a dependent parent, or certain dependent relatives. Okay, so a qualifying child is a pretty broad category. This includes biological, stepchild, adopted child, foster child, or a sibling if they meet the dependent tests. All right, so a little CPA exam hack we got here. Start by eliminating who does not qualify. That list is shorter. That can include cousins, foster parents, unrelated roommates. None of them are going to qualify as head of household dependents. So if Linda pays for more than half of the costs of her niece and the niece lives with her, yes, she can qualify. All right, but when thinking about the head of household status, as we mentioned, parents don't have to live with you. All right, so this is a very important head of household exception. Dependent parents. If Linda supports her mother who lives in a retirement home, but Linda pays more than 50% of the costs of that retirement home, she may still qualify for head of household. Why? Because Linda is still maintaining a home that serves as the parent's principal residence, even though Linda herself doesn't live there. But a reminder, they must be a dependent parent based on the dependent tests. This rule is frequently tested, so lock it in. Now for dependent relatives, a different rule is going to apply here. All right, so grandparents, siblings, aunts, uncles, nieces, nephews, these can all help the taxpayer qualify for head of household if and only if they live with the taxpayer for more than half the year. Linda cannot claim head of household just because she gives her cousin money. The relative must live with her, unless it's a parent. So quick memory trick. Parents do not need to live with the taxpayer. Other relatives must live with the taxpayer. Cousins still don't qualify. So let's wrap this section up with a quick snapshot of who counts for head of household. If Linda's claiming a child, then she's going to qualify. And they must live with her. If she claims a parent, this is going to qualify, but they do not need to live with her. If she claims other relatives, they qualify only if they live with her and they meet the dependent test. Okay, so this chart makes it easy to confirm if someone is truly qualifying as a person for head of household status. Remember, head of household has excellent tax benefits, so the IRS is pretty strict about who qualifies. All right, so before we move on, here's a quick compare and contrast because these two filing statuses, head of household and qualified widow or surviving spouse, often get mixed up on the CPA exam. Both taxpayers must be unmarried, but the key difference comes down to who's living in the home and how long they've lived there. Head of household requires a qualifying person, so this could be a child or even a dependent relative who lives with the taxpayer more than half the tax year. Okay, so remember, H for half the tax year equals H for head of household. Qualified widow or widower, aka surviving spouse, is much more specific. It must be a qualifying child, and the child must live with the taxpayer for the whole tax year. Okay, so remember, W for whole tax year equals W for qualified widow or widower. This status is only available during the 2 years following the spouse's death. So just remember, HOH, head of household, is half the tax year plus broader definitions of dependents. Widow, widower equals the whole tax year, and they must be a dependent child. So this tiny detail, half the year versus the entire year, can be the difference between choosing the right answer and picking a trap. So keep this distinction top of your mind as we continue. All right, so thinking about the filing status timeline here, let's apply what we've learned to Linda Larper's story again. Linda's husband passes away in year 1. She has a dependent child living with her through year 5, and she does not remarry. So here's how Linda's filing status would work. In year 1, she was married when her spouse passed. Okay, so married filing jointly is allowed. Year 2 and year 3, she qualifies as a widow surviving spouse, as long as her dependent child lives with her for the whole year. And then after those 2 years have passed, after the year of death, year 4 and year 5, she's now going to be able to file as head of household since she is still unmarried and still supports her dependent child. All right, so notice she only gets 2 years of surviving spouse status after the year of death. All right, so they were still technically married throughout that year in the year of death, therefore she's still going to qualify for married status. All right, but by year 4, even though her child is still a dependent, the IRS then rolls her into this head of household status. So this timeline comes up all the time in CPA questions. So if you memorize the rule that surviving spouse lasts exactly 2 taxable years after the year of death, you'll have a major exam edge.